You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast. This week, we're tracking a major tension-gripping global markets.
It's this profound disconnect, really, between central bank committees that are deeply divided and the kind of certainty that markets are pricing in for their decisions.
It feels like a pivotal moment. We've got policy announcements coming from the Federal Reserve, the Reserve Bank of Australia, the Bank of Canada, and the Swiss National Bank.
And we are seeing a highly fragmented global environment. Divergent inflation, different political pressures, all pulling policy in fundamentally different directions.
So you need to understand not just what these central banks decide, but why their internal debates are so fractured.
And why that's so crucial to the macro outlook. The stakes are incredibly high right now.
Let's unpack it. Okay, so when we talk about this week's action, we really have to analyze how the global landscape is being shaped by all these decisions packed into one short window.
Right, and you use the perfect term there, fragmented. That's exactly what it is.
What does that mean in practice, this fragmented policy environment?
It means central banks are, they're all confronting wildly different realities.
So not on the same page at all.
Not even in the same book. The inflation trajectories are different, growth outcomes are different, and the political pressures are totally unique to each country.
And we actually got a preview of this divergence last week, didn't we? It kind of set the tone.
We did. The Reserve Bank of India decided to ease policy.
A 25 basis point cut.
Precisely. They're citing rapid disinflation. Governor Malhotra even called it a rare Goldilocks phase for their economy.
Low inflation and steady growth. Must be nice.
Exactly. It gives them room to cut. But if you look at the labor markets in, say, North America or Australia, they are in a completely different universe.
Okay, that brings us to the biggest showdown of the week. The one that moves global markets.
The Federal Open Market Committee meeting.
Right. Markets are pricing in an 87% chance of a 25 basis point cut. That sounds pretty certain.
It sounds certain, but the drama is it's extreme. That certainty in the market is fundamentally contradicted by what's happening inside the committee.
And the situation wasn't helped by that prolonged government shutdown, right, that delayed some key data.
It made the policy fog so much thicker. They're meeting without a totally clear picture of the consumer, of retail sales, some of those key inflation metrics. They're flying a bit blind.
So let's get into that division. Who are the factions here?
It's nearly an even split. On one side, you have 4 voting members explicitly supporting immediate cuts.
Okay, who's in that camp?
That would be Governors Bowman, Waller, Mirren, and Williams. Their argument is really about preemptive action.
Getting ahead of a slowdown.
Exactly. Support a cooling labor market, avoid an unnecessary recession, especially when the data is so murky.
And a counterargument. Who's on the other side?
Leaning towards a hold, you have 5 voting members: Barr, Schmid, Collins, Musalem, and Goolsbee.
And their concern is?
Inflation, the persistence of it, the long tail. They believe core inflation just hasn't proven it's heading back to the 2% target for good.
And they're looking at forecasts that show PCE inflation staying above 2% all the way out to 2027.
Right. They just don't want to declare victory too soon. And that leaves Chair Powell and Governor Jefferson as the swing votes. It's on a knife's edge.
So with that math, even if we get a cut, it could be incredibly contentious.
Oh, yes.
We could be looking at 4 or more dissents against a cut.
And that's the real significance here. 4 or more dissents would be the highest number we've seen since the early 1990s.
Wow. And what does that signal to the market?
It signals instability. When the Federal Reserve is that divided internally, markets price in higher volatility. It creates uncertainty about where policy is headed next. A central bank that can't agree on the path forward really struggles to anchor expectations.
And what's fascinating here is it's not just about the economic numbers. There's this huge political cloud hanging over everything.
That is the biggest shadow over the entire macro environment right now.
You're talking about the imminent choice for the next Federal Reserve chair.
Yes. President Trump's choice is expected in early January, and it's causing some significant market jitters.
So let's say the pick is seen as strongly dovish, someone like Kevin Hassett, for example. Why does that immediately spook the bond market?
It all comes down to one word: independence. Bond investors get very nervous if they think a nominee is too closely aligned with an administration's political preferences.
The fear being they'd push for rate cuts to boost the economy in the short term, for political reasons, rather than focusing on price stability.
That's the red flag, a perceived lack of independence.
And the consequence of that is a Treasury sell-off.
Exactly. If the market thinks the Federal Reserve's credibility is at risk, if they think inflation is going to be allowed to run hot for political reasons, then the risk premium on long-term Treasury debt just skyrockets.
And you get a sharp sell-off, driving yields higher.
Precisely. This external pressure on the Federal Reserve is arguably just as important as the internal dissent itself.
Okay, so that's a divided, scrutinized Federal Reserve. Let's pivot now to the Asia-Pacific, the Reserve Bank of Australia.
A very different story, but just as tense.
Markets are pricing a 94% probability of a hold at 3.6% this week. But that hold seems to be masking some real stress.
It absolutely is. They are expected to hold, yes, but their recent communication, their quarterly statement, showed a surprisingly sharp, hawkish tilt.
So they're basically admitting they got the inflation path wrong.
Fundamentally wrong. And the numbers are stark.
How big was the revision?
They sharply raised their core inflation forecasts. They now see June 2026 trimmed mean inflation at 3.2%.
And that was up from, what, 2.6%?
Yes. And their main consumer price index forecast for that same period jumped from 3.1% to 3.7%.
Hang on. If they're forecasting core inflation at 3.2% in 2026, which is way above their 2 to 3% target, why hold rates? Why not hike immediately?
That is the tightrope they are walking. Governor Bullock's messaging after that was crucial. She said the board had not considered rate cuts. She said policy is viewed as close to neutral. And this is the key quote, "It is possible there would be no further cuts this cycle."
So they're hoping the tightening they've already done will be enough to cool things down without causing a recession.
They're banking on the lag effect, but the market isn't really buying it anymore.
What was the reaction?
It was immediate. Money markets have completely reversed. They now price no further cuts this cycle and have shifted to pricing the next move as a hike.
A hike, not a cut.
A hike, not until the second half of next year, but the direction of travel has completely flipped.
That puts the Reserve Bank of Australia firmly out of the easing camp. Let's jump back to North America, the Bank of Canada. They're expected to hold their rate at 2.25%.
Yes, and they've been pretty clear that they view this as the terminal rate. They think they're done.
At about the right level is the phrase they keep using.
It is. It suggests they're content to wait and see. But just like everywhere else, they are fighting the data.
The labor market, right?
The labor market. They had stronger than expected jobs and inflation data in September and October, and then the November jobs report was a huge surprise.
The unemployment rate dropped, didn't it?
Dropped significantly, from 6.9% down to 6.5%. That kind of resilience in job creation just completely changed the market psychology.
So even if the Bank of Canada holds and says, we're done, the market is betting against them.
Heavily against them. Before that jobs report, the market was pricing in easing by mid-2025.
And now?
Now it's flipped to be sharply hawkish.
Yeah.
There are 15 basis points of rate hikes priced in for 2026.
Yeah.
So you have this major conflict between the central bank's words and what the market is actually doing.
Okay, so let's quickly touch on the policy edges and some of the key macro data that will shape this whole narrative.
Sure. On the edges, you've got the Swiss National Bank. They're expected to hold at 0%.
Any chance of them going back to negative rates?
There's a non-zero probability, with inflation being cooler there, but officials have set a higher bar for that move. For now, they seem anchored at 0.
And then you have the Central Bank of the Republic of Turkey. A very different situation.
A very different easing cycle. They're expected to continue with cautious cuts, following their prior 100 basis point cut.
And that's supported by slowing GDP growth.
Yes, growth moderated to 3.7% year over year in Q3. So they need to stimulate, but the Turkish lira is under constant pressure. It's a very fine line for them to walk.
All right, what about key data releases? We have Chinese trade data coming up.
This is a vital one. It'll be the first full period to reflect that Trump-Xi trade truce.
Right, where the U.S. cut a tariff and China agreed to buy more U.S. farm goods.
The background is complicated, though. In October, U.S.-bound shipments plunged by 25%.
So we shouldn't expect an immediate boom from this truce.
No, more like a normalization. We're entering a period of unfavorable base effects, so analysts expect the numbers to cool a bit, even as Beijing ramps up imports.
Then back in Australia, their jobs report will be critical for that Reserve Bank of Australia narrative.
Absolutely. The forecast is for a modest gain of about 20,000 jobs, with unemployment ticking up slightly to 4.4%.
Which is what the bank wants to see.
Exactly. That's the normalization they need to justify holding rates. If that number comes in hot, the pressure to hike will be immense.
And finally, a quick look at United Kingdom GDP DAS.
Expected to rebound 0.2% month on month. But look, this one number is unlikely to change the Bank of England's thinking much.
They're already so finely balanced.
Very. Governor Bailey had to use his tie-breaking vote last time. They're focused on the longer-term path of inflation and wages, not a single month's data.
Okay, let's pull all these threads together. For you, the listener, how do we synthesize this intensely complicated picture?
I think we can group the central banks into three distinct camps.
Yeah.
Policy convergence is, it's just nowhere in sight.
Okay, camp number one, the easing camp.
That's the Reserve Bank of India. They're in that Goldilocks moment with disinflation giving them room to cut rates and stimulate growth.
Camp two, the caution, or maybe this stuck group.
That's where you put the Reserve Bank of Australia. They're holding, but they're revising inflation forecasts way up. It's a very, very cautious pause.
The Swiss National Bank fits there too.
Yes, anchored near zero, with a high bar for any big moves.
And finally, the group's wrestling with deep division or a surprise hawkish shift.
That's the Federal Reserve, defined by its internal dissent and all the political risk. And the Bank of Canada, where a strong labor market is forcing markets to bet on hikes, directly challenging the bank's own guidance. The environment is just defined by conflict, not consensus.
So given all that, the divisions, the uncertainty, what is the greatest risk to global markets right now? Is it a central bank that prioritizes political alignment over its independence?
Or is it one that's just paralyzed by its own internal disagreement, unable to give clear guidance?
It's a tough question.
It is, because paralysis and political interference both just erode confidence. A lack of independence creates this risk of long-term unchecked inflation, which is a structural nightmare. But that internal paralysis creates short-term volatility and makes it harder for businesses and investors to plan. I think the real risk might be the combination of the two.
How so?
A deeply divided Federal Reserve could become much more vulnerable to those external political pressures, and that's a dangerous mix.
That covers the immense policy divergence driving the global macro landscape this week.
Appreciate you tuning in. Join us again on the Financial Source podcast.